AI has defined the market with many booms. First, it was the GPUs and 10 times your money in Nvidia. Then the power boom followed with a 600% surge in Bloom Energy. And recently, memory chips drove a 29-fold payday for investors in SanDisk. It's life-changing money, and each one of these started with a shortage, a bottleneck in AI that made investors rich. Now I found the next bottleneck and 3 stocks that will make you rich. Each of these AI mini-booms started on a hidden bottleneck. In 2023, it was GPUs, the brain processing power for AI, and demand that NVIDIA CEO Jensen Huang called insane. Then, because of the massive demand for electricity from data centers, but a 10-year timeline for traditional power generation, stocks like Bloom Energy, ticker BE, boomed on the new solution. And even as the beneficiaries of the last shortage crumble, memory stock makers like Seagate, Micron Technology, and SanDisk down 10, 20, 40% in the last month, the next shortage is building in the AI pipeline, and this one is smaller than a grain of rice. It's called a multi-layer ceramic capacitor, or MLCC, and while you've probably never heard of it, every AI server depends on thousands of these to work. Think of an MLCC as a tiny shock absorber for electricity. AI chips consume enormous amounts of power, but not at a perfectly steady rate. Every time an AI model processes a data, power demand surges and falls almost instantly. Without MLCCs smoothing out those fluctuations, filtering that electrical noise and stabilizing the voltage, the processors become unstable, generate errors, or even shut down altogether. The faster and the more powerful AI chips become, the more critical these tiny components are going to be. And AI servers don't use just a few of these. Goldman Sachs estimates that NVIDIA's upcoming Vera Rubin server architecture could require as many as 600,000 MLCCs in a single rack. Goldman also says that MLCCs have quietly become the third largest cost item in an AI server, behind only GPUs and memory chips, calling them the next memory. That comparison should sound familiar because memory suppliers, those memory chip makers, became some of the biggest stock market winners in the last AI cycle. That same report forecasts the MLCC market, now at around $15 billion, is going to expand at an 80% annual pace through 2030. That is more than a 10-fold increase in demand. But the problem here is supply. Unlike many electronic components, high-end MLCC production is dominated by just a handful of companies in Japan, South Korea, and Taiwan. Building new manufacturing capacity isn't something that happens overnight. It requires years of engineering expertise, highly specialized production equipment, and long qualification cycles with customers. Murata, the global leader with roughly a third of the market, is reportedly operating at about 95% utilization, leaving very little room to satisfy a sudden wave of new demand. So that imbalance between supply and demand is exactly what investors need to be paying attention to. Delivery times for advanced MLCCs now exceed 20 weeks. Goldman believes prices could rise as much as 150% over the next year, and when component shortages meet exploding demand, profits are going to grow much faster than revenue. That is exactly what happened with the HBM, the high bandwidth memory chips, and it may be happening again. The question isn't whether AI will need more MLCCs. The question is whether the industry can build them fast enough. We'll get back to those stocks next, but first, I want to thank today's sponsor, Clover. We got 2 flat tires within a week of each other last month, almost $700 total, and with 1 in 3 families without the savings to pay for an emergency expense, that is exactly the kind of thing that can push you into a cycle of loans and debt. Fortunately, there is a better option with the Clover app, and that's because Clover is not a loan, it's your money. Clover is an earned wage app where you can access up to $750 from money that you've already earned, but before payday. There's no credit check, no late fees, and no membership fee. And here, I like that the process is easy and so straightforward. You're not taking out a loan, and there aren't any hidden fees. Clover makes its money through ads on the site, so it doesn't have to charge you to get the money that you earned. You're just getting early access to that money that's already yours. We all have those unexpected bills. If you're short on cash, access up to $750 with no credit check or late fees. Check out Clover, click on the link I'll leave below, or just scan the QR code here so they know I sent you. So then how do you get in on this next AI mini boom and make money? As a US investor, you don't, or you can't directly. The 3 companies dominating the MLCC movement are all Japanese stocks, and while I'm going to show you a backdoor way to get these stocks, I'm also going to show you 2 other options that I think are even better for investors. And it starts with Murata Manufacturing, ticker MRAAY on the OTC market. This is a company most investors think about when they look at MLCCs. This is the world's largest manufacturer of multi-layer ceramic capacitors with an estimated 35 to 40% of the global market share, making it the clear industry leader. While the company also produces RF modules, wireless products, sensors, and other components, MLCCs remain the largest contributor to both revenue and profits, making Murata the closest thing to a pure-play investment in this trend. Murata's biggest competitive advantage is its scale and manufacturing expertise. Producing advanced MLCCs isn't simply a matter of just adding capacity. AI servers require extremely small capacitors that can handle higher voltages, faster switching, and much greater reliability than consumer electronics. Murata has spent decades refining its ceramic materials, manufacturing process, and the customer relationships with virtually every major semiconductor and electronics manufacturer. This has not been a high-growth company or industry, which is why I think a shortage in that MLCC space could be so surprising and shoot this stock higher. In the year to March, revenue grew just 5% and profits before taxes barely budged 1.4% higher over the year. We saw something similar in memory maker SanDisk, ticker SNDK, with just 10% revenue growth to 2025. Before that, revenue jumped 79% in the last 12 months, and the stock shot up 2,900% on the memory shortage. Management at Murata is forecasting growth to accelerate to just 7% for this fiscal year, and for before-tax profit to climb 26%, but even this could be underestimated if a shortage in MLCCs drives those prices higher and a larger profit margin. And before that next stock, you're going to notice that all three of these companies' shares are only available on the OTC or over-the-counter market. This is a less regulated stock exchange used mostly by very small companies or foreign companies to offer their shares to U.S. investors, but without some of the strict regulation and oversight required to list on the New York Stock Exchange, the NYSE, or the NASDAQ. The upside to this is that U.S. investors can get access to these companies. The downside is that the OTC market is notorious for scam companies because of that lack of audited financial statements and the oversight. It's usually not quite the problem for these large multi-billion-dollar companies like these. For example, Murata is an $87 billion giant, but it does mean that you do have to do more research into the financial statements yourself. Next up, Taiyo Yuden, ticker TYOYY, is quite a bit smaller at just $8 billion, but if Murata is the market leader, Taiyo is one of the most focused competitors. The company generates a substantial portion of its business from those capacitors, along with inductors and communication devices, giving investors relatively concentrated exposure to passive electronic components compared to some of these other larger electronics manufacturers. And Taiyo Yuden has built its reputation around high-performance, high-reliability components used in smartphones, automotives, electronics, industrial equipment, and increasingly in AI servers and advanced computing systems. Rather than competing purely on volume, the company has emphasized premium products where performance and reliability matter more than the price, so you see the better profitability here when those sales head higher. That positioning could benefit as AI servers demand increasingly sophisticated components capable of handling greater power density. The downside on this one is that scale. Taiyo Yuden is significantly smaller than Murata and doesn't enjoy the same manufacturing scale or that customer diversification. We do see similar financials for Taiyo Yuden as we saw with Murata, slightly slower growth at just 4.1% revenue growth for the year, but a bounce to profit of 129% on a jump of factory utilization from AI server demand, along with that MLCC demand. Management sees revenue accelerating to an 8% pace this year and to leverage that higher to a 12% profit bump, but again, I think they beat that easily. The third stock here before I show you two easier ways to buy these. TDK, ticker TTDKY, is a different kind of investment. While it's a major producer of MLCCs and other passive components, capacitors represent only one part of a much larger technology company. TDK also manufactures magnetic sensors, power supplies, industrial components, batteries, and electronic materials that serve everything from smartphones to electric vehicles and those AI data centers. Now that diversification is going to be both a strength and a weakness. On the one hand, investors aren't relying solely on that MLCC story to drive those returns. TDK benefits from several long-term trends, including electrification, industrial automation, renewable energy, and AI infrastructure. On the other hand, if MLCC demand explodes, shareholders may not experience the same upside as they would for more focused or concentrated companies because that growth is spread across so much larger business. TDK growth was already the strongest of the three, though, with 13.6% pace of revenue growth in the year to March and a 16% increase in profit before tax. Management is forecasting a very conservative 3% growth this year and 8.4% profit increase. And While I do think they're going to beat this and surprise the market higher, this will clearly be the slower growing company if there is that MLCC theme takes off. I do like TDK for a little lower valuation, but the growth and the upside potential is definitely in Murata and Taiyo Yuden here. But before you rush out to buy any of these stocks, there are a few risks here to keep in mind, and I'm going to show you two investments that could be even better next. Of course, the biggest risk is just going to be that single company risk, that management drops the ball at any one of these and it underperforms. So if you are buying these, I'd take a position in at least two of them. Second, you've got the risk that Wall Street is getting ahead of itself already and overestimating demand for these MLCC producers and the stock prices. All three of these have already surged over 100% plus this year, and while they've come back into what could be extremely attractive prices, there's always the risk that the stock price already reflects that future demand. And since this MLCC mini boom depends on that broader AI boom, there's also the risk that AI spending in general slows across the entire supply chain. I see this as a pretty low probability though, and in fact, Goldman recently pushed back to say that AI spending plans would surprise higher, reaching $1.1 trillion next year. Against these risks though, instead of trying to predict the one company that wins in this race, I actually think there are two broader investments that offer as much return with less risk. First is going to be investing in the country funds holding these shares directly in the local market. The iShares Japan ETF, ticker EWJ, gives you exposure to 168 companies, most of which are not even traded in the US as OTC stocks. You get exposure to two of these companies along with the rest of the market. A more focused ETF for the theme, the iShares South Korea ETF, EWY, gives you exposure to 78 companies with another big MLCC player, Samsung, making up 22% of the fund. You also get companies across memory chips like SK Hynix, with the fund up 134% over the last year. I like those ETFs for getting even more of the stocks that aren't traded on the US exchanges, but there's a drawback here as well. Investing in either ETF means you're diluting that pure play return on the MLCC boom with the stocks of other companies. The South Korea fund is the most focused here, with 50% of its stocks in the tech space and many of them directly involved in artificial intelligence. But the Japan fund, while giving you those MLCC power plays, only about 19% of this fund is in tech stocks, so it's much less focused here. A more focused way to invest might be the Matthews Korea Active ETF, ticker MKOR, which holds just 51 stocks concentrating on the tech sector. Here, heavyweight Samsung is the biggest holding, but you've also got SK Hynix and other AI plays, including MLCC producers. This one is the more focused, with 46% of the fund in tech stocks. The fund has run to 106% return over the last year, with upside to go on this theme. With the MKOR, while it is more focused, you do miss out on some of those Japanese pure play companies, so you might consider some in those individual stocks and a larger investment in the fund to give you that exposure to more stocks. Get your money when you need it with Clover and the link in the description below, up to $750 before your paycheck. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.